Coming up in today's show, stocks finished the week mixed. We'll take a look at bank earnings results, the Bitcoin bait and switch, the West strikes back at Islamic militants, which sends oil and gold higher, and Tesla falls on delays coming out of the Red Sea. Welcome back everybody to the Click Capital Daily Market Show. Hope you're enjoying your Friday, Saturday or Sunday wherever you are in the world. And if you're new to this channel, stick with me right through to the end and I'm going to do my best to get you up to date on everything important that's happening across stocks, bonds, commodities and cryptos. And after watching this video, you'll have a really good idea with what's moving financial markets and what all the big underlying trends out there are. So hit that subscribe button if you haven't already. And I appreciate all you guys that hit that like button as well. And without any further ado, let's dive right in. So it was a bit of a mixed day to finish out the week. With Q4 earnings season kicking off by the big banks today. Got some mixed results out of them. I'll get into that a bit later on. Other than that, mega cap tech held up okay. We did see Tesla fall on some bad news, along with United Healthcare after their earnings. And we got a bit of a pop out of the oil and gas sector on the back of what's going on in the Middle East, all of which I'll cover a bit later on. First, just looking at the S&P 500, still edging up to those all-time highs, only about 35 points away here. Market's really coiling up. Other than that, it was a pretty flat day. Mega cap tech ended unchanged. The Q's only slightly up, and we had the Russell 2000 fall slightly. I got some interesting charts to show you today. Some things out there are moving, so stick with me, and we'll come back in and do some technical analysis a bit later on. So the four biggest banks in America always kick off earnings season. That's JP Morgan, Citigroup, Bank of America, and Wells Fargo, which we got to hear from today. And the results are a bit mixed. JP Morgan closed out its most profitable year ever with $9.3 billion in fourth-quarter income. Citigroup actually swung to a loss. They're planning to cut 20,000 jobs. And Bank of America earned $3.14 billion in the fourth quarter. That's down 56% from the same quarter a year ago. And Wells came in at $3.45 billion, up 9%. So JP Morgan for a really long time now, led by Jamie Dimon, who's been CEO for almost 20 years, is clearly the leader in the US banking industry. And they're forecasting more record profits to come this year. However, it's not all beer and Skittles for everybody in banking. Wells Fargo actually posted a jump in credit loss provisions, coming in at $1.28 billion. That's up quite a bit from $957 million the same period last year. CEO admitted there's a modest deterioration in credit, which he's closely monitoring. We also saw a few of the banks have to deal with some one-off charges. Actually saw Citigroup posting a fourth quarter loss of $1.8 billion, well down from the profit the same quarter last year. And same deal with Bank of America. One-off charges causing their profit to fall by more than 50%. And a big part of that, all of them had to pay, was a special FDIC fee related to the failures of Silicon Valley Bank and Signature Bank, as the industry and the Fed had to step in really quickly to prevent things spilling out of control. And Bank of America also has got more loans going bad. They took $1.19 billion hit in the fourth quarter, and that's really not a good sign to see when the economy's still holding up okay, unemployment historical lows. They've also got credit card debt at record highs, over $1 trillion. And so even though most people are still employed, we're still seeing Americans missing credit card payments at the highest rate in a decade. And that's because rates are the highest they've been in 15 years. So consumers are already feeling the pinch. You can just imagine what would happen if we were to go in a recession and the unemployment rate were to shoot up above 4, 5, 6%. I'd say we have a lot of people missing credit card payments. Then that's going to cause problems for the banks, which will then cause them to tighten further lending, which then sends the economy into a full-blown recession as credit gets a lot tighter. Just looking at the price action we got in the banks today, there's the biggest JP Morgan at $488 billion market cap, actually gapped up to a new high before giving away all those gains straight away and finishing the day on the lows. Same with Citigroup, gapped up, rallied, but gave it all back and just finished the day a little bit higher. Bank of America gapped down, held on a bit, but still finished 1% lower. And Wells was the worst performing of the bunch, down 3.34%. And just to give you a long-term look at how the banks have performed, there's a monthly line chart of JP Morgan. Going back to the start of 2007, before the industry went into that global financial crisis. And since then, it's recovered quite well. However, not so much for the other banks. If I just overlay Bank of America, that's still actually below its 2007 highs. Citigroup's even worse. It was hammered in the GFC, hasn't really recovered since then. And Wells Fargo has kind of done the best after JP Morgan. So JP Morgan really is the exception and is head and shoulders above the other banks. And that's why today it broke out to all-time highs, even though it gave it a bit back in the afternoon. Jamie Dimon is expecting more good things to come this year, but of course he doesn't want to spook the market and talk his stock down too much. Just moving on, the big story this week, the launch of the first spot Bitcoin ETF ETFs yesterday into the market, a long anticipated event for the industry, in which some bulls are calling a watershed moment. Now that it's legitimized, anyone can invest in it. But what a classic bait and switch. The market and price action's been in Bitcoin, running right up into the opening bell of yesterday's session, making all new investors pay up and actually drawing in a huge 655 million in net inflows into the top 10 Bitcoin ETFs. However, not everybody on Wall Street's in agreement that they're great for investors. We saw Vanguard not allowing their customers to buy the Bitcoin ETFs, which has upset a few people. And we've also got Goldman Sachs Wealth Management Strategy Chief saying Bitcoin's for people who want to pretend they're in Vegas and ETFs don't make the coin a legit investment. And there's a look at the daily price action of Bitcoin, having its biggest sell-off in many months, getting below the 50-day VWAP for the first time since September last year. And just taking you down to an hourly chart on Bitcoin, it was right up here, just below 49,000 a coin when the ETFs first started trading, and a lot of people bought into it. And there's a look at the biggest and largest of them all. That's the Bitcoin Trust from iShares, owned by BlackRock under the ticker IBIT. Opened up, shot right up to almost $30 a unit, and here we are the next day, already down over 15%, so all that new money is probably not feeling good right away. However, we've just printed the second daily candle, so it's still very early days, and it's yet to be seen whether these will turn out to be successful products, or whether the likes of Vanguard and a few other skeptics turn out to be right in trying to steer their clients away. This is one I'll follow closely on this channel, and should be interesting to watch how this plays out this year. And it's not just Bitcoin, got some other billionaires sounding caution on risk assets in general. That's the former bond king Bill Gross, wanting investors to be cautious as markets are looking dangerous, he said. Said investors shouldn't cash out but should avoid the riskiest assets, arguing that asset values increasingly reflect new fundamentals like Fed policy and momentum. And so even though he founded PIMCO in the 70s and earned himself the title of Bond King for many years, delivering really stable returns for his investors. He's now retired, but he's still active in his retirement, still watching markets every day and investing for himself. And he's actually got his own site, williamhgross.com, and he publishes his investment outlooks on there as well, with his latest titled Fundamentally Speaking. And he's talking about how the economy and markets have kind of moved on to a new paradigm away from QE, and saying today's finance-based global economies are moving in the wrong direction. Government and private market debt levels are at all-time highs relative to GDP, advising investors to be careful, saying these are dangerous times financially, geopolitically, and with the climate as well. He said in his own portfolio he owns lots of oil and gas pipelines at 8 to 9% tax-deferred yields, his favourite being MPLX. He still owns some banks that are below book value. He's got a small amount of mortgage REITs, and he's still doing a few merger arbs, with his latest being Capri, saying it should go through at its $57 acquisition price. And he finishes just by saying, I'm being careful, you should too, no matter how great NVDA looks, and don't get bulled up on bonds. A 4% 10-year treasury is no bargain in the face of 1.5 trillion deficits as far as an investor can see. So I thought that was pretty interesting from Bill, and the way he's really tilted his portfolio to high yielding stuff, while at the same time being mindful of a myriad of macro risks out there. And just staying on the macro, we got the producer price index data out today, with the headline month over month coming in a bit weaker than expected, contracting 0.1%, and core coming in flat. So that softening of an inflation input caused treasury yields to finish lower again across the curve, with the biggest pullbacks up the front in the 2-year, falling a healthy 12 basis points, getting down into the low 4s now. You can see that on the chart. The market's convinced inflation's on its way back down to 2%. 10 years holding up a bit better, but still below 4%. And if this were to go diving and take out this 3.8 and go towards 3.5, that would probably be a sign of some weakness in the economy. And just looking at a long-term 35-year chart of the 10-year, 2-year bond curve, that's racing back towards neutral zone. And I've just turned on the US recessions indicator, shaded here in grey on the chart. And you can see the bond market has a pretty good history of when we go inverted. Once we go uninverted, the recession's usually around the corner. We saw that in 1990, 2001, 2008, and briefly in 2020. We went just under going into COVID, and here we are with the bond yield curve being inverted since April 2022, and what's been one of the longest and deepest inversions in bond market history. And research shows that the depth and length of a yield inversion can be correlated to the depth and length of a recession, as we often see symmetry in markets. What goes down really hard can come up really hard, and vice versa. So we'll be watching this to go above neutral to see if it really is different this time like the stock market thinks, because looking back in history, the stock market always makes its low after the recession starts. So this is probably the most important and reliable macro indicator out there, and we'll keep an eye on it. Moving on to geopolitical news and oil. The US, UK, Australia and other Western allies have launched attacks to the Iran Islamic-backed militants, sending over 100 bombs and missiles their way to key targets in response to what they're doing to our ships going through the Red Sea, trying to disrupt global trade and making them pay a price for sending dozens of drone strikes towards these ships. And so the Biden administration, along with the Federal Reserve, everyone wants to see oil stay low going into the November elections. It's a big key driver of inflation and how Americans are feeling in general with how much they pay at the pump, how much extra cash they have for discretionary spending. Because all these militants attacking the ships are causing huge spikes in shipping rates, insurance rates. Some of the world's biggest shippers like Maersk having to reroute around the southern tip of Africa, making the trip a lot more costly. And that's already starting to show up, not only in shipping rates, but affecting companies as well. We've even seen Tesla facing supply chain delays due to what's happening in the Red Sea. And so even though the US-led airstrikes are designed to squash those militants and prevent further escalations, allowing global trade to flow freely, try and keep our inflation down, it's still a tightrope balancing act because the West doesn't want to ignite a full-on regional conflict, which would really blow oil and inflation out of the water. And so luckily, this is happening at a time when there's a lot of oversupply in the world and we've got some weak demand coming out of China and the Eurozone. However, it could be setting up the stage for a rise in oil this year, especially if we see a huge stimulus package come out of Beijing and they get demand pumping up again, as they're not too far behind America as the biggest consumers of oil in the world. And so we saw a bit of a pop-up in crude today, in addition to the shiny precious metal known as gold, and a bit of a flight to safety like we saw after Hamas initially launched their surprise attack on Israel back on October 7, gave gold a really good rally. It's been pushing up against all-time highs, but struggling to climb above and stay above there. And so the macro setup does have some similarities to the 1970s, when they had their first wave of inflation in the early 70s, and it came back down before we had a second wave in the mid-70s, then going into its third and final largest wave in the late 70s and the early 80s. So if you're wondering what's a good hedge, if that similar scenario were to play out again, we saw a spike in geopolitical risk events like we also got in the 1970s with the Yom Kippur War. And what's a good hedge against rising oil and inflation? Well, looking back at some of the best performing asset classes of that period of time was commodity stocks, in particular coal, oil, mining, and believe it or not, value stocks all significantly outperformed because the S&P 500 was basically sideways in that entire period. So stuff they dig out of the ground, coal, oil, and gold, anything mined increases in value during this period of time. And that's why I've got just about all of my own portfolios tilted towards commodities as a good hedge. I have done for a while and likely will remain tilted toward commodities for many years. Because whilst most people are still obsessing over mega cap tech, overall commodities are still really cheap relative to stocks. And just like in the dot-com bubble in the late 1990s, when growth stocks significantly outperformed commodities for the prior decade, like that period of time going into the early 2000s, we saw commodities, small caps, value stocks all outperform up until about 2010, 2011. And since then, commodities, small caps, value stocks, mining stocks have all significantly underperformed. And so we may see a massive reversion to the mean on this chart in the coming years. There's a look at the daily price action in crude oil. Been coiling up for a few weeks now. Shot a bit above the 50-day VWAP, getting above $75 a barrel today, but pulled back come lunchtime and just kind of sitting flat there above 72. Gold perked up a little bit above its 50-day VWAP, but still quite lackluster price action here in gold. Just seems really soft, pushing up against its all-time highs. We really need to see a big volume thrust above 2100 and hold if we're going to get gold in a nice uptrend this year. Moving on, just a reminder, stock markets closed on Monday to observe the Martin Luther King Jr. holiday. Bond markets will be closed as well. The Fear and Greed Index still at 71. Market's been persistently in a technical overbought situation for a couple of months now. Corporate insiders look like they've gone back on holiday, showing one of their lowest purchasing days in many months. Only 16 purchases logged yesterday. Just looking at stock market breadth, we've got less than half of stocks above their 20-day average now. Still looking good on the 200-day average at 72%. A little bit better today on 52-week highs, 377 stocks and ETFs. Some of the big ones, Meta, JP Morgan, Uber, Costco, Eli Lilly. On the other side of the coin, we've got 67 stocks and ETFs hitting 52-week lows with nothing too big in there. But one of the saddest ones showing up is AMC, trading at just $4.56. All those meme stock buyers, unfortunately, a lot of people got sucked into putting their whole portfolio into this thing. A lot of people new to the market were told this was, quote, going to the moon, unquote. However, instead of going to the moon, it actually went to hell, down over 98% from its meme mania highs back in mid-2021. And for those watching my channel, I said all of last year, even starting from January back here, that these little meme stocks are full of risk. Business was struggling, and the CEO tries to talk a good game, but really himself, he was selling his own stock and keeps selling more and more new shares to take on new capital infusions to keep the business alive. However, looking back in history, when you see stocks get hit this hard, it's very, very rare that they ever come back. They kind of left for dead zombies for years and eventually get delisted. Got a little bit of a pop-up in the VIX and a bit of a change for a Friday. We normally get the VIX crush going into the weekend. Market really didn't come off that much. Say with a long weekend and what's going on in the Middle East, option dealers maybe just pricing in a little bit more risk there. You can see that and a bit more of a pop-up in the volatility of the VIX index, the VVIX, which can sometimes be a bit of a lead indicator on the VIX itself, and just a slight pop-up in volatility risk premium, but a bit of a bump up in crude oil volatility, tracking a bit over 40% annualized. There's TLT trading really flat, just hugging its 50-day. High yield bonds close to breaking out to highs. Market still has an appetite for risk here. Dollar index just calling up as well. There's the latest on Bitcoin. Even Ethereum come off a bit, but holding up a bit stronger there. Commodities overall got a little bit of a bump up today, but lost it in the afternoon. Still got a bunch of volatility and natty gas ripping up. Best performing commodity today, and my favorite one for a long time, many of you know, uranium, having an awesome breakout today. Uranium stock ETF URA up over 7%. So just taking you out to a long-term chart of the price of actual uranium, the closest thing we've got is the Sprott Physical Uranium Trust listed on Canada's TSX. So uranium prices getting back to those highs we saw in March 2007. Then it kind of got hit really hard in the GFC. We had a bit of a bounce. Then we had that Fukushima accident in Japan, and it was kind of written off for dead, that it was too dangerous. The world's kind of given up on it, and it kind of just stayed like that for a few years. No real new developments and nuclear reactors, Europe moving away. However, around here we got Russia planning to invade Ukraine, which they said they weren't going to do, but they end up doing it. Exposed how leveraged Europe and a lot of people were to Russia's energy. And then so the market and world slowly coming back to uranium and nuclear, as it's a very powerful, clean, efficient form of energy when it's done right. And so it was the best performing commodity last year, and spot uranium prices are ripping hard. However, just switching over to the uranium stock ETF URA, that's still significantly below its 2011 highs. That's when we got the Fukushima accident right here. Uranium stocks got absolutely clobbered. And so we've had some big basing action, big volume coming into this ETF. And same with one of my top 10 picks for this year. That's the Uranium Nuclear Energy ETF. It's only a small fund, only 142 million under management, which shows there's not a lot of Wall Street big institutional money in it yet, which we're hoping to front run a lot of that. It's got a dividend yield of 4.34%. It's got 26 stocks that are involved in the supply chain of nuclear energy and uranium, and it had a pretty good rip today as well, up over 4%, taking down to the daily. Nice breakout there on above average volume. Helping my top 10 ETF portfolio have a pretty good day today, as well as the cannabis ETF breaking out on above average volume. And so if you'd like to track my top 10 ETF picks for 2024, you can do so by going to clickcapital.io/tracker. You'll be redirected to this sheet here. You'll land on the instructions page. And if you want to make a copy of this simple portfolio tracker for yourself, just come up to File, make a copy. That'll create a copy in your Google account that you can edit and no one else can see. Otherwise, you've got read-only access to my one here. And for those of you who have already used it, there was an error in the total percent gain loss cell that I just fixed, so you can come and make yourself another copy, or just look at the formula up here if you want to update your own copy. Then basically all you do is enter in whatever tickers you want, the quantity purchased, which you can use a position size calculator to help work out, the entry price, then the spreadsheet will do everything else, automatically updated every 20 minutes. And so my picks this year, I've tilted heavily towards small caps and commodities, and using the ETF AOR, which is an iShares global growth allocation, kind of global 60-40 portfolio, as my benchmark, and we'll see if my picks can outperform my benchmark. I'm not going to change anything for the rest of the year. I'm going to do this every year on the channel. Give you guys my top 10 picks and see if I can outperform the benchmark. Just as a reminder, this is not financial advice. Please do your own research. I'm just sharing my research with you and just having a bit of fun, seeing if I can beat my benchmark. Just getting back to the charts. International stock indices finished the week on a positive note. Just a slight little pullback in Nikkei after it had the best week out of them all. Aussie 200 still holding up pretty well as well. Looking at the spread charts, we had a huge rip in high beta stocks versus low volatility over the last couple of months. That's kind of pulling back now a bit, closing underneath the 50-day VWAP. But growth versus value still holding up there pretty good, and a bit of a pullback in small caps versus large caps as well. Same with discretionary versus staple stocks, and a bit of a dive in the spread we use to gauge global growth expectations. That's the price action of copper versus gold. So copper is a growth commodity, often used in a lot of things across many industries. Gold's more of a flight to safety commodity. And this has been in a downtrend for quite a while now. And so that doesn't bode well for global growth in the coming months. A little bit of a bump up in inflation expectations here. Seem to have stalled out a bit, maybe looking to get back above the 50. Apart from uranium, the other best performing sector today was junior gold miners, which is another sector I have in my 2024 picks. After that, the best performing sector was shipping stocks. A bump up in shipping rates from what's going on in the Red Sea. And these shipping stocks are still really cheap as well, like clean energy, uranium, and some other commodity stocks. It's got a huge dividend yield, over 13%, holds 49 stocks, super small, assets under management of 45 million. Worst performing sector today was the airline companies, getting smashed after we heard some earnings out of Delta. Once again, clean energy is still really volatile. We'll be looking for some support around these lows down here, starting to get a bit technically oversold. And I like this sector as well, not just for this year, but for long term. I think we've got some good valuations and yields. And just going out to a monthly chart, it's not just the clean energy ETF, which has 75 stocks from a lot of different areas of the clean energy industry. It's also solar stocks hit hard. And one area of the clean energy industry I find most interesting is that of hydrogen. Hit really hard. It's a small ETF, only 35 million. Technically looks like there's signs of accumulation, but for me, I'm more interested in green hydrogen, which I think the likes of Australia's Fortescue could be a leader in. This could be a big energy source of the future. And that's basically the process of using clean energy sources to separate water into hydrogen and oxygen. Very clean method of energy, and Fortescue has a very profitable iron ore business that they're using to finance their future growth into green hydrogen. And that's why it remains one of my favorite long-term stocks. And that still has a dividend yield over 6% as well. The PE only at 11. And technically he's been trading really well. Just broke out last month. Moving on, we've got the financial sector ETF still holding up there pretty good after today's earnings, but the regionals looking a bit softer. Moving on to the Mag 7. Still got Apple a little flat. I think Microsoft overtook it again today. It's the world's largest valued company. Others a little flat. Amazon, NVDA just coiling up at all-time highs. Meta breaking out again. And the weakest of the bunch continues to be Tesla. So we got news of their delays coming out of the Red Sea. They also cut prices in China again. It's another bad signal to the market. It looks like we lost that gap from the 14th of November. And we do have another gap up on the 2nd of November that hasn't been completely filled. So we are getting a bit technically oversold here. And it's starting to diverge quite a bit away from the overall group of the Magnificent Seven, which have been breaking out to all-time highs in the last couple of days. So unless the market really turns down, I'll be looking for Tesla to make a bounce and catch up to the rest of its peers, even though we do have a bit of bad fundamental news coming out. Active today was Cameco, the world's biggest uranium stock coming out of Canada. Really strong breakout and huge volume. Falling was United Healthcare, even though they slightly beat on earnings expectations, and Delta got whacked even though they beat on earnings expectations. Market didn't like their forecast and outlook, and what's happening in the Middle East might be spooking investors on airlines a bit as well, especially if we see a sustained bump up in the price of oil. Boeing's still in trouble, falling again today, and a bit of a bump up in the defense contractors after we saw those fresh military strikes on militants in Yemen. A little bit of a bounce in the telecoms after they got hit hard yesterday, and the regional banks, which we'll hear from over the coming week or so, trading a bit soft after hearing from the big guys today. And we've got Charles Schwab coming out next week. All right, guys, there we are on the S&P 500, pushing up against all-time highs. Looks like we're primed to break out. Volatility market says we're good to go. Yields are nice and low, unless we see a spike up in the Middle East and oil. That could spook the stock market next week if we get some further development developments over the weekend. Things should be good to go for an all-time high breakout next week in the shortened trading week. That's all I got for you now. Thanks very much for tuning in to Click Capital and hitting that like button. As a reminder, the market is shut on Monday. Hope you all enjoy your weekend, and we'll see you again come Tuesday night. Cheers.